Let's take an example of an American tourist traveling to Egypt. In Egypt, he can't pay in dollars to see the pyramids because it's not the locally accepted currency. He must convert the dollar in the foreign exchange to the local currency, in this case the Egyptian pound. In simple terms, this is what the Forex trade is. In today's video, we will learn more about Forex trading. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, Forex, and many more. So watch this video till the end and hit the subscribe button and click on the bell icon to get notifications for our future videos. So let's begin the video. What is the Forex market? The foreign exchange market, Forex, FX, or currency market, is a global decentralized or over-the-counter or OTC market for the trading of currencies. It covers all facets of purchasing, selling, and exchanging currencies at established or current rates. It is important to the world economy. It is by far the biggest market in the world in terms of trade volume, followed by the credit market. Currency exchange takes place on the foreign exchange market. They are crucial because they enable us to make local and international purchases of goods, services, and currencies. To engage in foreign trade and business, foreign currency must be exchanged. If you reside in the United States and want to purchase cheese from France, you must pay the French in euros, either directly or through the company from which you purchase the cheese. This implies that the American importer would have to convert the USD equivalent amount to euro. Investors use the Forex market to speculate on the changes in currency prices to potentially make a profit. Currencies are traded in pairs, so by exchanging one currency for another, a trader is speculating on whether one currency will rise or fall in value against the other. Currency prices change almost any time during the week. The market is open 24 hours a day, 5.5 days a week, and currencies are traded worldwide in the major financial centers of Frankfurt, Hong Kong, London, New York, Paris, Singapore, Sydney, Tokyo, and Zurich. That's almost across every time zone. This implies that the currency market in Tokyo and Hong Kong opens fresh at the conclusion of the U.S. trading day. As a result, the currency market can be very lively at any time, with continually shifting price quotes. How Forex trading works. The trade in Forex is carried out on currency pairs. A currency pair is the quotation of two different currencies, where one currency's value is expressed in relation to the other. The first listed currency of a currency pair is called the base currency, and the second currency is called the quote currency. Since currencies are traded in pairs, a trader who exchanges one currency for another is making a prediction about whether the value of the exchanged currencies will increase or decrease. A typical currency pair listing may appear as Euro to US dollar 1.3027. In this example, the euro is the base currency, and the US dollar or USD is the quote currency. The difference between the two currencies is a ratio price. In the example, 1 euro will trade for 1.3027 US dollars. It is paired but acts like a single entity, just like a stock or commodity. In trading, profit is made when an investor buys a pair, and then its price increases. Investors can also profit sell or short a currency pair, and its price decreases. Conversely, if the price falls, he will experience loss. Trading with margin. When trading Forex, you are only required to put up a small amount of capital to open and maintain a new position. This capital is known as the margin requirements that varies depending on the currency pairs and size of a trade. Currency pairs typically trade in specific quantities called lot. A lot is a unit measuring a transaction amount. Orders are placed in sizes quoted in lots when they are placed on your trading platform. The two lot sizes that are most frequently used are standard and mini, which correspond to 100,000 and 10,000 units, respectively. Depending on your brokerage company, micro lots are made up of 1,000 units. Margin requirements can range from 2% to 20% depending on the trade. However, for the majority of currency pairs, they typically range from 3% to 5% on average. To understand how margin is calculated, let's take the euro to US dollar pair. Say this pair was trading at 1.30 and an investor wants to buy a standard lot of 100,000 units. The total cost of the trade will be $130,000. That's a lot of money. The investor does not require to pay the full amount. He just needs to pay the margin requirement. Say, the margin requirement was 3%. 3% of $130,000 is $3,900. That is what he needs in this Forex account to place the trade. This brings us to the next aspect of the Forex market, leverage. Leverage involves borrowing a certain amount of the money needed to invest in something. In the case of Forex, money is usually borrowed from a broker. In the last example, the investor could control a large amount of $130,000 with only $3,900. Depending on the currency pair, leverage allows investors to manage a sizable investment with a comparatively smaller sum of money. One of the largest benefits of Forex trading, and occasionally the most dangerous, is leverage. It offers investors the chance to experience both significant gains and losses. Another important aspect of the Forex market is financing. The interest you pay or receive for keeping a spot currency overnight is known as a financing rate. It outlines the fees associated with borrowing money. The overnight loan rate for each foreign currency is different. Even though a currency pair functions as a single unit, you are still trading one currency against the other when you trade it. You technically short one currency and long the other. You lend the currency you are long, and we borrow the one we are short when it comes to financing. This lending and borrowing occurs at the respective currency's overnight lending rate. You will receive credit if the currency you had long has a greater interest rate than the currency you had short. If the reverse happens, then you will receive debit. The financing is done automatically by the brokerage firm. We have only discussed a few fundamentals of the Forex market in this video. One must first comprehend the Forex market and how it affects the trade. The Forex market has many risks and rewards, just like all other financial markets.
Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.